Good morning, everybody, and welcome to our webinar this morning. My name is Kevin Uphill, and I'm the chairman of Avondale Corporate. I'm joined by my colleague Mark Lebet. He's one of our M&A advisors. Good morning. So everybody, today we've probably got about an hour in total. We will be recording the webinar, so if you like it and you want to share it with your colleagues and friends, please do so. We'll be putting it on our website and circulating it. But if you also want slides, please let us know. We can make those available after the event. For those of you who don't know Avondale, we help people buy and sell companies. We also do some strategy work in terms of particularly shareholder value and business organisation design. And we are increasingly doing employee ownership trust sales. And within the business sale arena, there's also an awful lot of private equity deals. So shareholder value, of course, sits centre stage in many of those questions. How much is the company worth? Why is it worth anything? And how do you realise it? So today, that is the subject we're going to chew the fat on. Avondale specialise in the emerging mid-market, so that's companies really with a sort of enterprise value of 2 to 50 million. It is, I suppose, the quality end of the SME market, 10, 15 plus employees up to 300. And they all have their own peculiarities. Some of our conversation this morning may also apply to the slightly smaller SME. I do want to get some questions. We've got an hour, but I can't talk for a whole hour. Well, actually, it's probably not true, is it, Mark? I probably could. But I'd like to get some questions going towards the back end, just because it's more, effective, and you'll get more value. So that'd be really useful. So please heckle as we go in the Q&A box, and then Mark and I are going to chat about some of those at the end. So really to get going, so, today is to educate if we can. I think it's a very good slide, this, because there's a lot of white water. And fundamentally, what I'm talking about here is almost more scale up than shareholder value strategy. But I was invited to write a book in 2016 by Coben Page. And effectively, it was how do you put strategy back into companies, because people are being forced into agility, and the principle behind that being forced into agility is markets are in flux. There is a hell of a lot of white water. So I came up with this idea that actually, to navigate past that white water, what CEOs need to do is look for the eddies in the river. So the river is your market. And that market is flowing and it's constantly dynamic. And right now, with the COVID backdrop, I see more lockdown restrictions again. It's incredibly choppy white water. But you cannot navigate if you are constantly fighting the flow, your business model, because it's just exhausting. What you need to do as CEOs is find an eddy. That's a little spot by the side of the river that isn't being hit by the white water. Get out, look further ahead, and try and anticipate your route in the market in flow. So the concept really, and people go, well, that's great in theory, but in practice difficult to do. But if business models are changing more rapidly, and I believe they are, our research is that a business model will change now every 10 years by at least 50%. Whereas probably 30 years ago, every 10 years that change every 20 years that change would have been 50%. So the business you start today will look 50% different in 10 years' time. That's a statement. So obviously, if markets are moving more rapidly, then of course there's more white water, there's more flux. So it's more exhausting, but also there's more opportunity. And I think that's really important. And it's very easy to get caught with, the COVID changes and the difficulties we have in our economies. When actually, really what I'm saying is if you can anticipate where your future customer is going to be, what's the flow of the market likely to be further ahead than your competitors, and you can help your clients do that, then you will design a better business model, and that will be more valuable. So navigating the rivers of cash, a lot of white water, huge opportunity, but fundamentally, as a consequence, we've got to work smarter on the business model. And I think, again, great in theory. This is building more valuable companies, more sustainable. What's the kind of role of the CEO within that equation? Now, many of you, if you're advisors rather than clients, will know the Michael Gerber book, E-Myth, E-M-Y-T-H, E-Myth. He was the guy that came up with the first work on your business, not in it. Now, most business coaches, use this as a sort of almost Bible to their CEO coaching. And I agree with it. It's, design your business like a system, think of it as a franchise, put a process in it, make it less dependent on you. Work on the business, not in it. If you're a restaurateur, don't do the cooking, design the restaurant experience. And that's all very logical. Having said that, right now, if you're a restaurateur, you're being forced to look down because you're going, oh, okay, well, what's the impact on public spaces with masks because we've got more lockdown? So my view on this is that I think most people know the theory, but because you've got more choppiness in those white waters, whether that's COVID driven or tech driven, because I think tech is creating as much disruption to business models as is the economic drag of COVID, not to mention Brexit if you're UK based. So we are being forced to, as leaders, to look down, effectively increasingly being forced to firefight, even though we know that firefighting is exhausting, we'll be fighting the white water, and we will run out of steam in the river. So it's more important than ever to work on your business, not in it. But the problem with that, if you ask most entrepreneurs why they don't do it, and we've got some of you today, so maybe you can answer the question as well later. But the problem with strategy, the problem with getting into the eddy in the river and getting on the riverbank and looking further ahead, is it doesn't feel like work, because it feels like you're thinking. It's all the blue sky stuff. It's the less obvious stuff, and that's scary because you don't know whether it's going to work, because you're looking 2-3 years further ahead. And right now, there's all the obvious stuff in front of you that's creating crisis. So it's so easy to keep going hands-on and do that stuff because it feels like you're making a difference. Whereas in reality, where you end up with is a poor business design because you haven't made enough changes to the strategy. So this triangle is like kind of the role of the CEO. You want to move away from being in HR, finance, premises, ultimately delegate if you can. Obviously, this assumes you have the luxury of doing it in terms of finance, marketing, know-how, operations. And the value for CEOs is, what are our future customers going to want? Who are they? What's the demographic of those customers? How do we design the business around that? What research do we need to do? What new products do we need to do? What acquisitions and alliances? Within that top phase, I was really interested to see an email yesterday from Dun & Bradstreet about 70% of CEOs saying that they believe data is going to drive their core strategy. We had a big marketing workshop yesterday, and it was really interesting how everything we did, it kept pointing back to, well, who's the customer, what are they doing, and what's the data? So I think there's massive work that we can do, creating more valuable businesses and scale up, looking at what our data is telling us. When I wrote the book, Creating Competitive Advantage in Dynamic Markets, I came up with a concept, which is, if you're going to map your business model ahead of the flow of the river, the market, and the white water, then we need to look at the line of probability for our sector. Basically, there were two ways that you could do that. One, looking internally at your own data. What is it telling you? What's the demographic doing? What's happening? Who's your customer? How's that changing? What's happening to your market? but two, looking at the broader big data in the marketplace. And when you look at that line of probability for your sector or your business, actually, it's always really interesting to look outside of your sector, because often the biggest disruption to business models comes from the sector alongside you, not the sector you're in. So the point I'm making is CEOs get very drawn into corridor thinking within their current sector, but actually the energy and the ideas come from slightly off piece. So that's why it's critical to take time to do that research and look at what's happening in your parallel sectors when you're designing the business model for value. So the high value stuff is at the top, the low value stuff is at the bottom, and ultimately you need to create a team-driven business model. So the companies that are most valuable are the ones that are team-driven. They are less dependent on the owner-manager, more dependent on the business model and the team driving that business model. And that's really, really important, probably the biggest multiple influencer or value influencer. So again, when we do our strategy work, and we've got a team of a couple of strategists, I sometimes sit in on it, so I enjoy that. My role is to sit across all the services we offer. But when we look at the strategists, when they go into companies, they do business reviews. They also do what we call vendor assist, which is a sort of 360-degree review of the business to design it to make sure we got the best shareholder value when we go to exit. So sale preparation work. And it's really interesting when we look at companies, it's the stuff that the CEO enjoys and or the COO or FD or, you know, the one and two within the business tends to work well. The stuff they don't enjoy tends to be the bits that we need to go and sort out and fix, and often is where the energy is. So it's really, you know, this is about actually, do you know what? If you want to create a more valuable business, you've got to be objective, and you need to do a more objective review of the business. And your team can help that. A team-driven business is by nature more valuable. So that these are some of the areas that buyers look at from a due diligence perspective. So if you're going to be sale ready and have a more valuable business, we need to go through line by line and look at all the different elements in order to design the business model to have more value. And team-driven, and then back on the other side, finance, KPIs. You know, if you can't produce a dashboard that tells people why it's a better business, then it's not a more valuable business. And so data and dashboards also sit center stage on this equation of how we design more valuable businesses. If we're running, you know, a vendor assist project, so that's where we do this sort of sale ready shareholder value thing about a year in advance, sometimes 6 months in advance, we simply go through and scorecard all that. And that's really useful. The one that we find really interesting, as I say, is the management. We have this model, we call it cultural to commercial. The problem with many emerging mid-market businesses is they've probably recruited, they may have had job descriptions when they did that. The business has evolved and outgrown those job descriptions. So one of the really cool areas, so we don't need to go out and raise lots of money to grow a business. We don't need to, you know, necessarily get in private equity. We can design value. If you're going to create a team-driven business, which by nature are more valuable, who's doing what? How good are they? What are their roles and responsibility? Are they clear on it? And fundamentally, the cultural to commercial model is SMEs are cultural, they're a village. EMEs probably go somewhere in the middle. Commercial is the corporates. The commercial is Jack Welch's, bottom 10% out every year, 360-degree appraisals, roles and responsibilities, hold ruthlessly accountable, and if you're not doing your job, you're out. Now, most EMEs can't do that because, of course, you know, it's difficult to recruit the top talent. But what you can do is more work on and clarity on those roles and responsibilities, and then basically training people around how they do more of the lifting in the operations. If you remember that triangle I had earlier, lifting in operations and sales and marketing, so that you and all your client and CEOs have more time to think and look further ahead in the market. And when we look at that, we often ask, well, what's the training budget, guys? How much have you spent on your second tier management? So not only have you not got clear roles and responsibility, you're not necessarily holding them accountable, because they're coming to you going, how do I fix stuff that's in their job role, not the other way around. Add to that, they haven't necessarily been trained. When you're up against corporates, they're spending, 5K a year on their executive training. How much do EMEs spend on their executive training? It's very slim. And of course, it's a great return on investment, because if you can get your team to pick the ball up and run with it on the small evolutions, then you can place more time from a board point of view in terms of, well, how are we going to fix this business model against the future customer need? And therefore create what I call pull, not push. So push is where you need to sell all the time and you've got to persuade people that they need to use you. Pull is customers coming going, look, guys, we can see you doing something different. We can see the value in your products. We want it. We need it. And they're seeking you out, not the other way around. And of course, by nature, that would be a more valuable business. So if we're going to work on the business, leadership, not management, we're going to try and create a more team-driven business. We're going to get the team to do more of the small evolutions so we can get a bit more hands-off. And then we're going to look at the business design, the org design, and go, how do we create more value? How do we create more sustainability? For me, that starts with questions, not answers. Too many CEOs come in going, it's their idea and it has to be their idea. And they don't ask the question from the team. And for me, within that, it's also the diversity of that team. I was having a great debate and with on the marketing yesterday with our sort of marketing team, and we're just not sure that LinkedIn and Facebook fits our business model because it's social media stuff. But I have to say, that's right now, the 30-year-olds in that team are utterly, ruthlessly convinced it will come, that we cannot ignore it. And that's about, putting your own views aside and listening to the team. Often, it's the punks in your team that have the best ideas. So we were working with a professional services firm recently, quite big, about 150 people. And we were looking around it going, well, why is the business under stress? And as I looked around the board, all of them were between 53 and 60. All of them, well, there were quite a few balds, but there was a few grey hairs, all male and generally white. No board diversity, no females, no young people. How are you going to get strategy into that business? Because they all think the same, right? And that's your punks that can have some of the best alternative ideas. So they may be younger, you need to go downstream, you need to engage, you need to hook in on what they're doing. And for me, that's then, with all the questions, you need to be able to figure out what your plan is to place it ahead of the market, be clear what that is, and then cascade it down across the team. We're going to create a more valuable business, the scale up is, and here is how we're going to do it. And too often that plan isn't articulated and nobody knows exactly where it is. And within that context, a little telling off for CEO entrepreneurs. And the biggest weakness we see is what we call kite flying. So entrepreneurs by nature are optimists, they're enthusiasts, they're easy to sell to because the next salesman that comes in with great ideas mirrors that optimism and enthusiasm. They hear what they want to hear. And before you know it, the strategy is zigzagging according to who's the best salesman and or strategist in front of them that day. Now, the reality is, I liken it to the D-Day landings. If you want to build a more valuable company, you cannot fight across 300 miles of coastline. when we won the D-Day landing situation back in 1945, they took 2 years to work out how they were going to do it, and they attacked on just 5 miles of beach. Just 5 miles of beach. I think it was even narrower than that. The law of focus. Don't spread yourself too thin. Again, in our marketing session yesterday, a big point was, well, we could do that, we could do that, we could do that. No, 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 because we're already doing lots. Do the stuff we're doing better, do it well, say no. And CEOs really struggle with saying no. So the law of focus is really important for valuable companies and scale up. And for me, that's about time as well. The guys that are really clear what their business, the guys and girls that are really clear what their business plan is, are really clear when they're spending time on strategy, not management. Management is, where the teething issues, what the operational issues, is John or Janet any good at their job? Strategy is, how do we influence our multiple to make the business more valuable? How do we create pull in the market rather than push? Who are our future customers going to be? What new products are they going to need, and how are they going to be buying it? So really clear, yes, being able to borrow money, private equity, that's all relevant for scale up. Of course, we may need cash to design more valuable businesses, but time is as important a commodity in the marketplace. So for me, if we're also designing more valuable companies, we need to know what buyers place in terms of value of businesses. And this is a slide that sort of shows you what we think are the key multiple influencers. And quality of earnings, of course, sits center stage. So the more recurring the revenue, the more spread it is across customers, the easier it is to get value for that business. But also, I think, increasingly, the point I made about the law of focus and being clear where you can be different, what niche can you own, brands are becoming more valuable. If people are looking at you going, wow, it's quite a nice business, but actually there are 10 or 15 other businesses doing the same sort of thing, then by nature, you're in a race on price, aren't you? Whereas if people are looking at you going, they're doing something we're not, we need to be doing that. We don't quite know how to do it. They're ahead in the market. They've got more recurring revenue. The brand stands out. We can see they've created we need with their customers. Then the price earnings multiple goes up when you're valuing that business. So it's basically, buyers and private equity, and sorry if you're a finance director, they love a spreadsheet. It's all about profit. No, multiples are influenced by a lot more than the profit. How sticky is the revenue? Is the market demographic on the up for that sector? How strong is the business model against that? And also, we're seeing a trend that the CFO is increasingly, again, if they are too hands-on just doing the finance and outputting that, guys, with Xero, with Sage, with Merlin, there's some great systems out there. The CFO does not, the finance manager does not need to be spending so long on the account. So you need to challenge and look at their role, because it's morphing in EME businesses to almost a COO type role as well as CFO. They can, employing a bookkeeper or a finance manager and then pushing the finance director type role, so it is more on the organization rather than just adding the numbers up. There's some real value in that. And within that context, most EMEs do not have a CTO. So CTO, Chief Tech Officer. I've said earlier, more valuable companies, tech is within that foundation, but tech is also the biggest disruptor, far more so than COVID. Again, if you look at how business models have changed, COVID has accelerated the tech change. and of course, tech companies are perceived as more valuable. So within the foundation of the business, how are you using tech within the foundation, not as an add-on? So what we're seeing is most companies don't have a CTO, Chief Technical Officer. They have a break-fix MSP, managed service provider, and there's no design being put into how they join their tech platforms up. But the great news is the old way of doing it, you used to have Oracle or SAP or one of the big heavyweight machines to join all your processes and systems up. Increasingly with cloud-based apps, the skill is actually in the APIs joining the various cloud apps up. So you can get rid of this island of information. So if we're going to look at how does the CRM join to the account system? How does the account system join to the ERP and the inventory? And therefore, what is the data output? What does that tell us happening to our margins and our future customers? So tech becomes the core of the business, not the outlier. But if you haven't got a CTO and you've only got an MSP, you need to get help on designing this, because it's what the corporates are doing and you're up against them. So I think it's important, we're going to do some questions in a minute, but I think it's an important point here that it's a very technical expert world out there, and it's critical to ask for the right help if you're going to navigate those rivers of cash and be avoid the white water and the flipping over. Too many people don't research what is the right help, in our opinion. So again, I just mentioned MSPs, managed service providers. If they don't understand what a CTO is and you don't know the difference, then you've got a problem, right? Because you're not then going to be able to put IT center stage in your business. So can you go and find an interim CTO? Who is that? How do we do that? If you're struggling, we've got a bank of them. But the point I would make is that for EME, emerging mid-market businesses, there's a lot of advisors out there, and many of them are SME expert advisors, not EME expert advisors. There's a fundamental difference in the pressure on a business and business model when you start getting to this 20, 25 people plus up to the 200 size organization. And those businesses need more design, and the expertise for that organization design is not just SME, it is more specialist. And good CEOs will be more objective about where they need that help and bring in those experts within that, around that. So again, a classic, but we often ask the question, how much time is spent on strategy, not management, in board meetings? And a classic, oh, well, you know what, actually, we've got out of the habit of board meetings because it's been so busy out there and we've been firefighting and, it's been crisis management. And it's like, yeah, okay. But we're not going to design more valuable businesses doing that. We need the workshop. And, if the board meeting is a reporting meeting and a management meeting, that is different to a strategy meeting. A strategy meeting is the blue sky stuff. You may only need to do 3-4 days a year, but are you doing it? And so being clear how you're spending your time, what you're spending it on, whether it's strategy or management, and also how you can get help as a team to bring objectivity to that, means that you can create a more valuable business. But living on thin air, as a reminder, it's not all about capital. The old view of growing companies was you needed to have cash, you needed to have CapEx. Of course, business angeling, invoice discounting, there's huge amounts of private equity. So an awful lot of the deals we're doing right now are private equity there. Any business with a sort of 600-700K plus profit or a post-COVID run rate is in huge demand, and there's lots of attraction for private equity. So not really sales. And again, there's banking support. So yeah, of course we need finance to run our businesses, but the value for us we see today is in the ideas, the data, and where you spend your time, and how you cascade that business plan down to the team. I mentioned earlier agility, not agility versus strategy, and I love this quote. So John Harvey Jones was the ITI guy. For those of you who are old enough to remember him, he had a TV program called The Troubleshooter, and he used to go in and basically review emerging mid-market businesses with a corporate mindset. Great series, still fun today, but it's a lovely quote. So one of the things we do when we speak to a new client, we ask for obviously the account so we can assess the value, but we ask for the business plan. And I can tell you, we probably only get it on a third of occasions. So that's quite shocking. So back to, well, how do organizations know what to say no to if they haven't got a clear plan cascaded across the team? In terms of realizing value, we need to talk about it. We're designing more valuable businesses. There's all sorts of ways to realize that value. You've got the traditional private equity trade, MBO. Private equity is incredibly busy right now. Trade, I have to say, a little distracted. MBOs, slightly harder work with civil loans in place. Banks are more cautious. We are seeing employee ownership trust as a really key area where we are realizing the value, typically on a loan note basis, over 7 or 8 years. The great thing about those sales, it's 0% tax and very culturally soft, but also the private equity, the price earnings ratio, because it's effectively the company buying itself for the benefit of the employees, can be on what we call an EBITDA or EBITDAC model. So EBITDA is earnings before interest, tax, depreciation, amortization. EBITDAC is the C, is the post-COVID run rate. What's the adjustment for COVID? So employee ownership is really a good way to sell because you can take that risk yourself, whereas buyers can be nervous about that post-COVID modeling, post-COVID recovery. But the other point about shareholder value, and I think it's important, there's an assumption that you've got to be looking at shareholder value, a year out before you sell your business, and it's all about sale preparation. I don't think you have to be selling your business to design more valuable businesses, right? I mean, your business is a good investment. It may be that you're a long-term player, but it doesn't alter the fact that it should be in the board and it should be in the discussion. Not how do we make more profit tomorrow, but how do we create a more valuable company alongside making that profit? And there are slightly different decisions on that journey. And some of the questions are here, really. For me, my favourite, and Mark, I don't know, have we had any questions from people? Please throw them in if you've got them. It'd be very helpful.
We've had a few.
We've had a few. Great. Okay. So, I mean, the big one for me, which I will just talk about, and then Mark, if you can read some of them out, it'd be great for me. And anything that's occurred to you as well would be helpful from what we've covered. But the fundament for me is when I go out and look at a lot of companies, and we've got the great advantage, we see 40, 50 EMEs a year. The one thing that shines out for me is how so many people design their business around, oh, we're better in the end because it's our people. Well, better people is a hygiene point. It's a bit like saying I've got a clean kitchen. You can't sell a business model on better people. In the end, it's how you're designing the organization of the business to be better. People are part of that, but so is the whole supply chain metrics and so on. So I think it's a really important thing. We CEOs, we tend to be arrogant. We assume our business is better, but is it really? And within that, therefore, huge energy, walking out into the wilderness and going to look at your competitors, utterly objective, and going, well, actually, what are they doing better than we are? And how can we steal those ideas? And of course, that takes time. So you've got to shift where you spend your time to do that. But for me, that's a really important one, because buyers will place more value on businesses where they can audit the strength, if you like, of that better. They are literally measuring it. Better team, better tech platform, better brand, better IP, better business model, better websites. The sum of the parts equals more value if you want to realise that when you get there. Mark, what questions have you had?
Yeah, so first question was, why do owners planning? And I think that comes from model point.
So why do owners?
In planning.
Why do owners not do planning? So it breaks up there. Yeah. So why do owners not do planning? It's the whole. It's well, two things. I think there's the 1 minute manager problem, which I struggle from, which is a great book. It's delegation skill set. You know, don't come to me with the problems. Come to me with the answers. So they then end up being hands-on too much because they feel that they're the one that's supposed to have the answer. So, and there's a real fear. I think entrepreneurs generally love to work hard. They're grafters. And as a consequence, planning's all about working smart. That's scary because I say it just doesn't feel like work. So in the end, there's something there around the fear of not being busy, and the you know, to not be busy and do planning takes fresh minds, and it's not easy to build that space, and they feel guilty doing it, and that undermines them, and they panic, and then they go hands on all the time because it's obvious and it feels like work. So if you've got views on that, guys, if you want to post them up, we'd be happy to share. Mark, any other thoughts or questions?
Do you have resources to help us get good structure into a team, the expertise and infrastructure that we need
to build
the sale?
Prepare the sale. Yes, so we've got a core team of strategists. Interestingly, we're doing that right now with a business where we've got 3 shareholders. They don't all want to stay after the sale. They're all quite hands-on. And so we've gone and done a full detailed business review and audit to work out what the new leadership team will look like and how we do that and whether we do any of that before sale or after sale. Quite interesting. We've discovered that the warehouse manager is paid 20k more than the going rate and isn't using the IT system properly. So not only have we got a dinosaur because he's there for an accident of history, but commercially out of pace with the going rate for the market. So that independent review is really useful. We had another one, a software business in the southeast, lots of recurring revenue. Finance director on 90k. To be honest, lots of recurring revenue, not many clients. Interim finance director would have been 20k. Finance manager 45. Again, 30k cost saving, which you know, we employed. All of that, of course, goes to the price earnings multiple when you come to sell. Yeah, so if you're on a multiple of 6 or 7 and you've saved 30k on that, that's real value to the business. But more importantly, it's creating lean. I would say 70% of the time when that strategy team go in, the org chart has no bearing whatsoever to the roles and the real roles and responsibilities. So if anyone wants it, do write to me or Mark. We have what we call a roles and responsibilities audit. It's a really clever little Excel sheet. All it does is list all the different things the exec team could do and who's doing what, and it asks you to tag it. And then we see it a bit like, I'm a 70s child, those puzzles where you move the tiles to create a picture. It's then a case of going, well, hang on, is that logical, and moving it about? And that's the sort of stuff we mean by org design. Who does what? Are they any good at it? How are they being held accountable? Is it in the right place? Mark, have we had any other questions or thoughts?
Yeah, I've got one more. So many struggle to delegate well. What's the typical bottleneck?
I famously gave one of our managers a book on how to delegate, and I asked him how he got on with it, and he said, I don't know, I've given it to the team to read. And the principle behind that, I could not argue. I thought it was hilarious. Really wound me up. Really wound me up. Because I'm like, no, you still need to study it. You still need to study it. It's best practice. I think it's the Peters principle. So the Peters principle is that we promote ourselves to our highest level of incompetence. It makes sense, right? You're good. You go up the ladder, you get to a point where you hit the glass ceiling, and unless you go and get help or training or support, and whether that's, our strategy team or an MBA, they do a little leadership course at Cranfield, which I'm told is quite good, or IOG courses as a director, the old habits kick in, you don't work on your weaknesses, and you then end up with lots of very poor driving habits. As my family are really keen to point out when I'm driving, it's time I do an advanced driving course, right? Only one hand's on the wheel. I was teaching my daughter to drive, and I was telling her she needs to look in the mirror, and she came back the other day and said, no, it's really important. You will fail. You have to be looking over your shoulder the whole time when you're reversing. I'm not teaching her right, because I don't do that. I didn't know that. So I'm out of date and I wouldn't pass. So they don't get help and they don't get the training, and delegation is one of those ones where bad habits very quickly come in. I think we have another one here. What point in the process should management or staff be made aware of a plan for a trade sale? Mark, do you want to try that one?
I would say that that's very dependent. A lot of it depends on the process, the scale of the business, the size of the team. It can be quite disruptive if they're told too early, but that very much, from our perspective, a case-by-case basis. Employee ownership, for example, our post-completion toolkit's quite in terms of how you manage that process, how you manage the message, making sure that that's on point, so as not to dispel any false illusions of what the real restructure looks like. But in general, I would say very, very case by case. Sorry, not too specific.
No, I think it's right. And so investment and employee ownership, you'd probably be more open. Trade, I'm a last minute guy, or even after the deal. They're too choppy. It's too high risk. You might bring the finance team in earlier because you need it to build data rooms and stuff. So we do, if you look at our sale launches, we do everything around a data room these days rather than just an IM to make it sale ready. So buyers can make a decision from anywhere in the world. That's quite metrically. That does need more work perhaps than the shareholder team can do on their own. So that can be awkward. But so often we bring in the finance team on a deeply confidential basis early on, but everybody else, not till it happens. Too risky, too distracting on trade. Investment and EO, I think, are a little different. The other point about that data room concept, the sort of sale ready concept, we no longer go to the market without doing the vendor assist bit, which is really a form of pre-sale due diligence. If we're not happy with the terms and conditions, or we don't think the website reflects the positioning of the business, we need to get that stuff looked at in the course of doing an M&A project, rather than assuming that the buyer will fix it. More valuable companies can be designed within the strategy and the time spent on the shareholder and CEO team. But of course, more value can also be got through running an effective process. And that is, how do you create an auction? How do you create that we want motivation in buyers and investors for the business? So if you're going to go for a competitive arena, getting the data ready and understanding that and being able to present that in the right way does take a bit of time. So we like to talk to people, you know, even 6 months to 9 months out, and often 3 years out. Good. Okay. How are we doing questions, Mark? Or we
yeah, I just had one more just come in, I think, just conscious of time as well. What can financial officers do to influence scale up?
Masses, masses and masses and masses. Most CEOs, as I say, they're entrepreneurs, they fly kites. And I don't want people who are bean counters that are looking at not spending money. You know, it's all about understanding the return on investment. So, you know, helping CEOs understand where they need to say no and where they need to focus in order to get ROI. There's lots of modeling there. Justifying the job because they can do trial balances and P&L and, you know, all that stuff. Come on, the IT system should do that. The CEO should be trained to look at that as well. So some CEOs don't fully understand the difference between a P&L and a balance sheet. Again, come on, educate. I think it is around helping you know, create visibility in the data and the dashboards for the whole team, sitting on the board and holding accountability around ROI, and where CEOs are looking at initiatives, making sure, not a no, but keeping discipline within that decision making. And that's not about being tight. I'm sorry, I'm a financial person, tight as a duck's arse. However, sometimes you can be too tight and undermine yourself, right? So FDs have that problem. They need to break that cycle. What's the investment? What's the cycle? How much does it cost? Where are we going to get the ROI? Help the CEO around that. And finding ideas as well. It's not all about the CEO. I do have a good joke with this, Mark. There's a MD and a CEO. So let me pick FD. So there's a guy in a hot air balloon, and he's floating along, and he comes down to the ground, and he sees this chap on the ground, and he says, "Excuse me, do you know where I am?" And the guy on the ground says, "Yeah, I'm at you're at a latitude of 32 degrees, and you're 25 foot off the ground." And the MD goes, "Well, that's hopeless," because the MD's the guy in the balloon. And the guy on the ground is the FD, and he goes, "Well, you're a typical CEO. You've got your head in the clouds and you've got no idea where you're going." And he says, "Well, you're a typical FD. Your information's too specific and it's not of any value to me." So I think it's really important that actually great businesses are built around teams. So let's have that dialogue around, have we got that problem within the organization, and how do we break that silo? So good. Okay. Well, I hope that's been useful for you all. As ever, we've enjoyed ourselves. If you've got questions or observations, please email us. Please kick us in. I'd like to thank Mark for a last minute stand-in on Tim Hardman, who couldn't make it today. So apologies, his email's not here, but he'll be on LinkedIn if you want to reach out to him as well. Any observations, questions, what you want to hear next, please let us know. We've got some other webinars coming up, and you know, be welcome to get you to join those. And thank you all for listening. Really appreciate it.
Good. Thank you.